You're just waiting for the other participants to join in. At 8 p.m. sharp, we'll start. Good evening, everyone. I am Satyamir Nandedkar, and on behalf of Zell Education, I welcome you all to this very interesting webinar, which is something that I chanced upon while I was preparing for my ATX classes. If you have had any exposure to UK tax laws, I am sure you are aware of the fact that there are a lot of provisions in UK tax which give concessions, deductions, and a whole lot of benefits to married couples. And throughout the course of this discussion today, whenever I say married couples, I will also be talking about civil partners. That is, individuals who are in a live-in relationship, which is a registered live-in relationship. So we'll be talking about the benefits and the exemptions that are there for married couples. We'll understand how a couple being married gets them a whole lot of advantages in income tax, in capital gains, and most importantly, when we are talking about inheritance tax, again, there is a whole lot of advantages that married couples get. It could be in the form of the gain becoming exempt via a no gain, no loss transfer, or it could be in the form of an exempt legacy where a gift is given by husband to his wife or vice versa, and that gift will have certain other benefits attached to it. So our discussion today is going to be centered entirely around that, on what kind of benefits are available to married couples. The contents of today's discussion, you can have my number. My number is 7709041555. You can have my number and you can message me on WhatsApp. I'm also there on LinkedIn, Satyamir Nandedkar, that's my name. So you can get in touch with me on LinkedIn, and all the material that I have prepared for today's class and the part that I'm going to be preparing today, I will be sharing that for everyone's reference. So do not be worried about that. This webinar that we are doing today is a part of an entire series of webinars that I have planned for taxation. Today's webinar is focusing on one aspect. Honestly, I wanted to title this webinar as "Why Should You Get Married?" Because when you look at the amount of exemptions and benefits that married couples get, I'm sure that is what even you will end up saying, ki why should uh, a person get married, only to get all these different benefits under tax laws. Now, without wasting any more time, let's begin our discussion for today. I hope you can see my screen. Now, to begin our discussion, the first part focus. So there are three taxes under which we are going to receive this benefit. The first one is income tax, wherein a lot of reliefs are available for married couples. Then we'll be moving on to capital gains, where certain transfers, if you are a husband and wife, then certain transfers are exempted. And of course, then we'll be getting into details of inheritance tax, where the number of benefits is even more. Okay, let's start with our discussion on income tax. Just a moment. Just let me know in the chat box if you cannot see my screen. Okay, so our discussion today is going to start with income tax, wherein we'll discuss marriage allowance. Then we'll discuss what benefits you get under rent-a-room relief. Then certain benefits that you get on ISAs, that is individual savings account, and the tax planning measures that you can put in place. Then we'll move on to capital gains, but let's focus on one thing at a time. Talking about marriage allowance. Acha guys, any doubts that you have, please feel free to put those doubts in the chat box and I will answer those. I might do one thing. I might answer those doubts towards the end. So if need be, I will unmute you so that you can also participate in the discussion. Okay, let's start with marriage allowance. Now, under UK tax laws, up to a certain extent, you are exempt from paying tax. What do I mean by that? Say if your total income is £20,000, then the UK government, His Majesty Revenue and Customs, they are kind enough basically to acknowledge the fact that in your case, you should not be taxed right from the first penny that you earn, but up to a certain extent, that particular amount should go untaxed. So every individual gets a personal allowance of 12,570. Now, what is this personal allowance? As I was telling you, if my income is 20,000, I have a personal allowance benefit of 12,570. So the net amount on which I will have to pay tax will be 20,000 minus 12,570. I have to pay tax only on the net amount. Because as I said, the government is cognizant of the fact that it is unfair to tax everyone at the same level, and you should not be taxed from the first penny that you earn. So every individual gets a 12,570 personal allowance. Now, if you are a married couple, one spouse can elect for his personal allowance, his unused personal allowance, to be transferred to the other spouse. This will be very beneficial, specifically when the other spouse has a lot of taxable income, and the marriage allowance can go to a certain extent in reducing the tax liability. So the way it works is, in case of what is marriage allowance, transfer of personal allowance from one spouse to another spouse, if that spouse has any unused PA. PA is personal allowance. If one spouse elects to go for transfer of personal allowance, a fixed amount is reduced from the PA, that is personal allowance of the transferor. This amount reduced is 1260 regardless of the amount unused, and the recipient spouse, the second spouse to whom the amount is getting transferred, you don't increase the personal allowance of that spouse. You straight away give a benefit in the form of tax reduction to the other spouse by doing 1260 into 20%, and the second spouse's tax liability gets reduced by 252. Now, let's have a look at one simple question to understand how the personal allowance part actually works. I hope you can see my screen. Let's look at this basic question on transfer of personal allowance. Okay. Now, the question says, Aljaz and Tala are married. Aljaz is employed and earns a salary of 35,070 per annum. Tala spends most of her time looking after their two children, but works on a Saturday, earning an annual salary of 6,000. They do not have any other income. Tala makes an election to transfer the marriage allowance to Aljaz. Now, what you have to do in this case is you have to transfer the unused personal allowance from the spouse, which is electing to make the transfer, to the other one. Now, let's pay attention to how that works. Okay. Write down total income. Write down total income for the husband and total income for the wife. The husband Aljaz earns a salary of 35,070 per annum. And Tala, the wife, she earns annual salary of 6,000 per annum. Now we know that the maximum personal allowance that you can claim is 12,570. Now observe carefully. Tala does not have enough income. She has only 6,000 worth of income. And what is the limit of personal allowance? The limit of personal allowance is 12,570. So if I were to reduce this, there would still be unused PA if I were to adjust PA to arrive at taxable income. I would use 6,000 out of 12,570 and 6,570 would be unused. Okay. Now, what does the provision say? The provision is very clear. Regardless of the amount of unused balance, regardless of how much is unused, the transferor spouse gets to transfer only 1260. Okay. So what is the reduced PA of Tala? It is 12,570 minus 1260. And how much does that come down to? 12,570 minus 1260, 11,310. You don't need that much PA. Okay. So less personal allowance. Now observe carefully. Here you can subtract only 6,000 Here, Aljaz has a personal allowance of how much? He has a personal allowance of 12,570. Okay. What did the provision specifically say? For the transferee spouse, you cannot increase PA for the transferee spouse. Okay. So after I adjust this, what is my taxable income? My taxable income naturally is 35,070 minus 12,570. And for Tala, it is reduced to 0. Now, what are the tax rates that I need to be aware of? For individuals in the United Kingdom, you always classify income into 3 subcategories: the non-savings income, the savings income, and it is followed by the dividend income. This is the order in which you are going to do your calculations. But here, all that subclassification, subdivision is not there. So you will straight away, and what are the slabs? 0 to 37,700, 37,701 to 1,50,000, and more than 1,50,000. Now, because this clearly falls within the first slab, tax at the rate of 20%. What is tax at the rate of 20%? 4500. Okay. Now, Aljaz is the recipient spouse. Aljaz is the recipient spouse. His tax liability will be reduced by 1260 into 20%, that is 252. So you do not increase the PA, but this marriage allowance reduces the amount of tax liability. You subtract 252 here and you will get your tax payable as 4,500 minus 252, 4248. Okay. So if a question tests you in the exam on use of marriage allowance, from the transferor spouse, you reduce 1260 in the PA. And when you go to the transferee spouse, what you do is you reduce the tax liability by 1260 into 20%, that is 252. It's a plain calculation, absolutely no scope for any other ambiguity. The law is very clear on how you have to operate. Now, this was the marriage allowance part. The second part in individual taxation where spouses get certain benefits is the rent-a-room relief. Now, the rent-a-room relief is for a very specific case when you are talking about property income. Okay. The rent-a-room relief is applicable when an individual lets furnished accommodation in the individual's main residence. Okay. When an individual lets out a furnished accommodation in his main residence, a special exemption applies. What exactly is this case? Say, for example, I'm living in a 2-storied building. I stay on the ground floor, and the first floor, a couple of rooms, I let it out to someone. That is rent-a-room. That particular letting out qualifies for rent-a-room relief. I could also have a case where I have a house which has 6 rooms, and out of that, 1 room I have let out to, say, a student or a paying guest of sorts. Now, how does the rent-a-room relief normally operate? If the gross annual receipts before expenses or capital allowances are 7,500 pounds or below, the income will be exempt from tax. The individual can elect to ignore the exemption for that year if a loss is incurred. We'll see what that means. But if the gross annual receipts are more than 7,500, the individual may choose between paying tax on the excess of the gross rent over 7,500. Okay. What happens is, in case the total income from letting out 1 room in your premises is less than 7,500, you could simply call the entire income as exempt income. But if the gross receipts from letting out 1 room or a couple of rooms in your premises are more than 7,500, say these are 8,000, then you get a relief to the extent of 7,500 and you have to pay tax only on the balance amount. Now, one point you need to remember when you are doing this is, There are two options that are available in case of rent-a-room relief. What are those options? One, you can continue to pay tax on the net amount, that is 8,000 minus 7,500. You can pay tax on the net amount of 500 at whatever rate is applicable. The second way is you calculate property income in the normal way. If you have reasons to believe that if you do your calculation in the normal way, the amount of taxable income will be lower, or you might have a situation of loss. In that case, you can ignore to use the rent-a-room relief. Now, where does the married couples wala part come into play? The married couples wala part specifically says that a married couple or civil partners who take in lodgers can either have all the rent paid to one partner, who will then have the full limit of 7,500, or have the rent divided between them and each partner will then have a limit of 3,750. Now, if there is an individual and his wife, they jointly own the property, or they don't necessarily own the property jointly, but they want to let a couple of rooms on rent to, say, students, for example. Now they have two options in this case. In case of married couples, the entire rent can go to one person. You could probably choose that spouse whose total income is less. Or if you want to split the rent between the two, then the rent can be divided between the two spouses, but the exemption limit of 7,500 will also get split in that case, and each spouse will be eligible for a 3,750 ka exemption. Going back to our previous example, if I were to say that my total rental income that I receive from letting out a couple of rooms is 10,000. There is an individual and his wife. The 10,000 ka income could be split between them, but at the same time, the 7,500 ka rent-a-room relief that you get, that will also be split. So 5,000 will go to their individual tax computations. You will subtract 3,750 from both and pay tax only on the balance of 1,250. So income gets split, and at the same time, the exemption limit of 7,500 also gets split equally between the two partners. Now, when you have to basically plan on how should income be taxed, you have a lot of options wherein you can transfer some sources of income to the spouse that is earning lesser income. For example, if one spouse is a basic rate taxpayer and the other spouse is a higher rate taxpayer, okay, couples can, so that is the specific case we want to be looking at. Couples can transfer income generating assets between them at no tax cost to minimize their joint tax liability. Income generating assets. For example, there is a fixed deposit which earns interest at the rate of 6%. One spouse could transfer the fixed deposit to the other spouse who is in the basic rate band or who is not earning any substantial income, without having any capital gain implications or inheritance implications or income tax implications. The fixed deposit could very easily be shifted from the higher earning spouse to the lower earning spouse, thereby shifting the tax liability to the lower earning spouse. We saw how personal allowances are used. The way personal allowances are used, you could also use the starting rate band in savings income and the savings income and dividend income nil rate bands to minimize the amount of income that can be treated as exempt. Let's take a simple example. For example, I am a higher rate taxpayer and I have around 20,000 of savings income. And because I am a higher rate taxpayer, the savings income nil rate band that I am entitled to is only 500. Worst case scenario, if I am an additional rate taxpayer and my total income is, or total taxable income in this case happens to be more than 1,50,000, then naturally I will not get the benefit of any savings income nil rate band. In this case, what I could do is I could transfer the interest income generating asset to my wife. I could transfer the interest income generating asset, that is a fixed asset or any other investment, to my wife. It will not have any tax implications for me, but in this way, it will be shifted to my wife, who, let us assume, is a basic rate taxpayer. She will get 1,000 worth of savings income nil rate band, which was not available to me. So my overall tax liability can be reduced. Now, the dividend income nil rate band, on the other hand, does not reduce even when the taxpayer jumps up the brackets. So even for an additional rate taxpayer, the dividend income nil rate band is 2000. But if one member of the couple has dividend income in excess of 2000, he may wish to transfer some shares to the other to utilize the other's dividend nil rate band. When we discuss capital allowances, we'll see that when there is a transfer of one chargeable asset from the husband to the wife, it is treated as a no gain no loss transfer. So if I were to if say I had shares of Reliance on which I was earning a lot of dividend income, I could very easily transfer the shares at whatever value to my wife. The value is not important. And why is it not important? Because any transfer of chargeable assets from the husband to the wife or vice versa or between civil partners is treated as a no gain no loss transfer. So when I transfer my shares to her, I do not have to bear any capital gains liability or income tax liability. But what happens in this process is that the dividend income gets shifted to the wife, and when the dividend income gets shifted to the wife, she can utilize the nil rate band. I could be smart enough and say, for example, I have around $4,000 worth of dividend, 4,000 pounds worth of dividend income. What I could do is I could transfer half of the shares to my wife. If that happens, half of the dividend income, let us assume, gets shifted to her. Out of the 4,000 dividend income I anticipate to her, half of it now will be to the credit of my wife's account, and the 2,000 pounds of dividend income nil rate band could be enjoyed by both the husband and the wife. Had this provision not been there, I would have to pay tax on the balance 2,000 after adjustment of the dividend income nil rate band. As I already discussed with you, whenever I use the word spouse, it also applies to partners within a civil partnership. Okay. So whenever you want to make this kind of tax planning, always keep in mind that you can very easily hive off or transfer any capital asset from one spouse to another, because that transfer is going to be treated as no gain no loss transfer. The transferor spouse will not have any capital gains or inheritance tax or income tax implications, but the income will get transferred to the transferee spouse along with the asset, and you can make use of the unused PAs or starting rate bands and the nil rate bands. So this helps to, in a way, rationalize the tax liability within a family. Now, let's discuss one aspect of what happens when there is a transfer of assets between a spouse. We have been harping on this for a while now. Let's see how that part works. Okay. When I'm talking about transfer of asset between spouses, I'm basically interested in understanding the capital gain implications of my activity. Now, when husband transfers an asset to a wife or vice versa, or this transfer is between civil partners, such a transfer is treated as a no gain, no loss transfer. There are no CGT, that is capital gains tax implications, on the transferor spouse. Okay, no capital gain for the transferor spouse. And the transferor is deemed to have disposed of the asset at acquisition cost. Now, let me illustrate this with a simple example. Okay, so let's assume in this case that Aljaz transfers a building he had purchased for 2 lakh to his wife. Okay. And so for Aljaz, this will be treated as a no gain, no loss transfer. For Tala, the wife, it will be assumed that she has acquired the asset at the same cost at which it was acquired by the husband. Okay, so deemed cost of acquisition for the wife is 1 lakh. Sorry, 1 lakh, 2 lakh in this case. Deemed cost of acquisition for the wife is 2 lakh. And see, the reason I call it deemed cost of acquisition is because she is not the one who actually acquired the asset for 2 lakh. But because of these provisions, we deem it, we consider it when it is not the case that the cost of acquisition for her is 2 lakh. Okay. Now, assume she sold the building for 3,50,000 later. So, capital gain for the wife would be 3,50,000 minus 2 lakh, that is 1,50,000. So normally, had this provision not been there, the taxation would have operated in a different way. You might have said in that case, in the absence of this provision, that the wife does not have to pay anything for acquiring the asset, so her cost of acquisition is as good as nil, and entire 3,50,000 would have been subjected to tax. But because of this provision, 2 lakh is considered as the deemed cost of acquisition for the wife, and capital gain is calculated accordingly. Please keep in mind that market value on date of transfer from husband to wife is irrelevant. So if that data is given to you in the question to confuse you, please be sure of the fact that the data is irrelevant for decision making. Okay. Now, the couple can use this. Say, for example, the husband has already other capital gains, and adding this is only increasing his tax liability. We could very smartly make a transfer effective from the husband to the wife. So the wife can then use any annual exempt amount, any brought forward losses, and all of that. So this will help to reduce the overall tax liability for the couple as a whole. Now, capital losses cannot be transferred between spouses. So where one spouse will make a gain and the other one a loss, it is possible to transfer the asset or a part of asset before the disposal on no gain, no loss basis. So one spouse makes both disposals and the loss can be used to reduce the gain. Please be mindful that you cannot transfer the loss or you cannot transfer the gain by itself. What you can do at max is you can transfer the asset before the second spouse incurs a loss, so that the gain and loss happen with the same partner, and you can set it off. Transfer of losses or transfer of gains is not allowed, but you can transfer capital assets so that gain and loss happen with the same person and you can offset the amount of loss. Okay. Now, that was the capital gain implication. We'll understand how to do smart tax planning based on this. Let's look at one very simple example. Say, we'll continue with the same one. Aljaz has the following capital gains. Okay. On building. On building equal to, say, 3 lakh. On shares equal to another 1,50,000. Tala, his wife, has the following situation. Capital loss expected on disposal of antiques. Okay. On disposal of antiques, she is expecting a capital loss of 48,000. Okay. This is the only situation. Now, if you want to best utilize and assume that she is a basic rate taxpayer. Okay. So what you can do is capital loss expected on disposal of antiques is 48,000. She is a basic rate taxpayer, and this is the only capital transaction during the year. So She has a loss, expected loss of 48, expected loss of 48,000. What else does she have? She has annual AEA of 12,300. So Aljaz could transfer shares to her which are or which will be enough to give her around 61,000 worth of, or instead of saying 61,000, let us say 60,300 worth of capital gains. Okay. So he transfers the shares to her. The transfer of shares is a no gain, no loss transfer. Okay. And in her tax computation, what will be the amount of capital gain? The amount of capital gain that gets transferred will be 60,300 less AEA. How much is the AEA? 12,300 less capital loss on antiques. It could be 48,000, and her chargeable gain would be reduced to 0. Now, if you observe, Aljaz in this case is an additional rate, most likely to be an additional rate taxpayer. Look at the amount of his gains. If you want to reduce Aljaz's tax liability further, you could transfer more shares to wife. That way, she will pay tax under the basic rate and his tax liability will be reduced. So in your ATX exam, guys, nobody is going to ask you straightforward questions on, calculate the tax liability or calculate the amount or whatever. They will test you on your ability to do efficient tax planning. Now, this is one basic part of your tax planning where you say that transfer those many shares to her which will generate a gain of 60,300, and that is completely fine. But you can very clearly see that the husband is a higher rate taxpayer or an additional rate taxpayer in this case. Transferring more assets from the husband to the wife will reduce his liability in the highest slab of 45%, and she will then pay tax at the rate of 20% because she is in the basic rate band. When the husband's liability reduces, it will get reduced by 45%. But when the wife pays tax, she will pay tax at the rate of 20%. So as a unit, they will save around 25% of the tax liability. So your planning has to be done accordingly. Okay? And his tax liability will be reduced considering a rate of 45%. Okay? So say for example, you transfer gains worth 1 lakh. Okay? Husband's liability will reduce by 45%. Wife's liability will increase by 20%. Why? Because she is a basic rate taxpayer, and the family as a whole, the couple as a whole, will still stand to gain 25,000 worth of savings. So this is how the tax planning activity can be done. In your exam, be careful about these basic details because that will help you fetch the highest amount of marks. Again, do not shy away from writing detailed explanations the way we have written here. The ATX exam will basically expect you to explain your ability to sound convincing and put forth your point. So be very clear on how you are writing these answers. Okay. Now, let's talk about, yes, Srivatsan, tell me, you can unmute yourself and talk. You are allowed to talk now. Go ahead.
Hello.
Yeah, go ahead.
So, sir, in that case, where can you just go back to that question?
Yes.
That
Yes, I have gone back to the question.
so we can, if a similar question is asked in the exam, we can do one thing. Is like everything except the 12,300 we can transfer to the wife.
Yeah, depends on again facts of the case. What if, in the exam, they also tell you that this person has some brought forward losses, or he has certain trading losses which might get adjusted against this income, right? So it will depend on facts of the case.
Okay, sir.
But see, if you transfer all of the gains, then she will become an additional rate taxpayer. Now, we don't want that. We want them to have the least possible tax liability as a couple.
Oh, okay,
Yes.
okay, okay. Okay, sir. Thank you.
Welcome. Now, this is the whole wedding, the whole destination wedding scenario, wherein if you get certain gifts on the occasion of your marriage, you are also again entitled to certain exemptions. So if a person is getting married and you receive a gift from your parents, a cash gift or a gift from your parents, then a gift from parent in a marriage is exempt up to £5,000. If the gift is from your grandparent, up to 2,500 worth of the gift is exempt. Don't you think it is a very smart way to convert your black money into white? And gifts from a party to a marriage, if the husband gifts something to the wife or vice versa, then that gift also to the extent of 2,500 pounds is exempt. And any other person who comes to attend the wedding, if that person gives you 1,000 pounds, then to the extent of 1,000 pounds, your gift is exempt. Now think of a situation where this is a very crafty way in which tax avoidance can happen, tax evasion can happen. A person who has a lot of unaccounted income in cash, which he has not yet disclosed to the authorities. And if he were to suddenly disclose, a lot of questions might be raised regarding the source of that income, and there will be an in-depth inquiry happening in this case. What he might do is, during his wedding, he might invite 50 of his friends, hand over those 1,000 to each one of them in an envelope of sorts, and they come over and hand him over that envelope of 1,000 pounds as a gift. Then 1,000 into 50, 50,000 worth of unaccounted cash income suddenly becomes legitimate, proper income. And then, of course, it can be offered to tax. So, as devious as it sounds, a marriage, a wedding event can be used for a lot of tax planning. And I'm sure you know of people who might have done something similar. Okay. Now, the next concept that we want to discuss is that of interspouse transfers during and the implications on IHT. IHT is your inheritance tax. Now, inheritance tax is a tax which is very specific to the United Kingdom. You will not have come across anything similar in India. Long ago, when I say long ago, many, many moons ago, we had something known as an estate duty in India. We also had something known as wealth tax in India. But right now, all of those have been abolished. I think wealth tax got abolished in India somewhere around 1450. So if you try to draw a parallel in India about this, you will not find anything. So this is a very special case. This is a very special case of tax, that is the inheritance tax. Now, if one spouse transfers something to another spouse as a gift, lifetime transfer of assets between spouses is exempt. It is exempt as capital gains. It is exempt under inheritance tax also. If a dying spouse on his death leaves his entire shares and building and everything to the wife, that amount that has been left to the wife is known as an exempt legacy. So transfer of assets on death is an exempt legacy and is a very effective tool for tax planning. If you give it to your son or daughter or whatever, there will be inheritance tax implications. But if you transfer it to your wife, there are no inheritance tax implications. That part is also exempt. Now, let's have a special situation where the spouse who is transferring the asset is domiciled in the UK and the spouse to whom the asset is getting transferred is not domiciled in the United Kingdom. To discuss domicile, domicile is basically different from residential status. There is an entire discussion on the 4 types of domicile where you stay, basically domicile of origin, domicile of dependence, domicile of choice, and then of course there is deemed domicile. Right now we are not getting into that. What we are saying is if the transferor spouse is UK domiciled and the transferee spouse is not UK domiciled, then gains to the extent of 3,25,000 are exempt. Gains as in transfers to the extent of 3,25,000 are exempt. So if the UK domiciled spouse transfers asset on death to the non-UK domiciled spouse to the extent of 4 lakh, then 3,25,000 is exempt and the inheritance tax is charged only on the remaining 75,000. In such cases, an election can be made by the non-UK domiciled spouse to be treated as UK domiciled for inheritance tax purposes. Of course, when you make an election, you have to notify the HMRC. Now, the nice part about this election, or the beauty of this election, is that this election is applicable only for inheritance tax purpose, and the person can continue to be treated as non-UK domicile for capital gains and for income tax purposes. So, and what is the use of this particular election? If there is a UK domiciled spouse and a non-UK domiciled spouse, the transfers are exempt only up to 3,25,000. But if both the spouses are domiciled in the United Kingdom, then all transfers are exempt. So it is in your favor if you were to make an election to move from being non-UK domiciled to UK domiciled for inheritance tax purpose. Now, let's quickly understand the provision of what happens on death of a spouse and what happens to the nil rate band. Now, when you calculate inheritance, of course, it is all the assets transferred and it's an entire set of calculations. But to reduce your tax liability, the way you had a personal allowance in income tax, you have a nil rate band in inheritance tax. There is a nil rate band for all the transfers and there is a residence nil rate band for main house property in which the person has been living. Now, if one spouse dies and there is an unused nil rate band, okay, one spouse dies and there is an unused nil rate band, then the unused nil rate band can be transferred to the surviving spouse. But there is a very clear mechanism on what amount of nil rate band can be transferred. Okay. Now, suppose Mr. A died and the nil rate band in the year of death was 3 lakh. Nil rate band used by him was 1,80,000. Okay. When he died, in whatever year he died, maybe it is say 2009-10, let us assume that in that year, the nil rate band was 3 lakh. Okay. The nil rate band used by him was 1,80,000 and 1,20,000 was unused. It had not been adjusted against any transfers. So understand that out of the total nil rate band of 3 lakh, 1,20,000 is unused. So what is the proportion of nil rate band? 40% is unused. Okay. So what gets transferred to the surviving spouse is not the amount of unused band, but the percentage of the unused band. So for Mr. A who died, his nil rate band was unused to the extent of 40%. Okay. The surviving spouse was his wife, Mrs. B. She has her own nil rate band of 3,25,000. So she can claim her own nil rate band of 325 and she can also claim the proportion of the husband's unused nil rate band. She will not claim 120. You are not supposed to claim the absolute amount. You are supposed to claim the percentage. In husband's estate, what was the proportion of unused nil rate band? 40%. So in the wife's computation in the year of her death or for other purposes, in that year, the nil rate band was 3,25,000. You will calculate 40% 40% is coming from here, you will calculate 40% of this 3,25,000 and 1,30,000 will be the amount of transferred nil rate band that she can use for herself. Now, this is where we need to be careful. By our common sense logic, we would have adjusted 120, but the provision is very clear. The provision says that it is the proportion of the unused band of the deceased spouse that gets transferred to the surviving spouse. So 120 is not transferred, 40% is transferred. Use this to calculate the 40%. Multiply this 3,25,000 by 40% and you get a transferred nil rate band of 3,25,000 into 40%, that is 130. Now, one last provision. This is the administrative part of it. Now, what does it say? It says very clearly that the executor of the surviving spouse, so surviving spouse also dies. Mr. A died, now Mrs. B also died. The executor of surviving spouse must claim transferred nil rate band or RNRB by submitting IHT return, inheritance tax return, by later of 2 years from the date of second death or 3 months of the or within 3 months of the executor starting to act. By the later of these two dates, you should submit a return of inheritance tax to be able to make a claim for the unused nil rate band. Okay? Now, ISA. ISA is a very, very interesting provision that is there in UK taxation. Now, an individual savings account serves a very interesting purpose. What purpose does it serve? Say, for example, I am earning some 1 lakh pounds of income every year. Now, what I do is I start transferring money to an ISA. An ISA is a separate account which has a lot of tax benefits. You could have a cash ISA, or you could have a shares and stocks ISA also. If in that individual savings account ISA, you create an individual savings account in your name, you open it with, say, an HSBC bank, for example, and in that ISA, what you do is you start purchasing the shares and you put it in that ISA. Now, any share that is in that ISA, when it is sold, the capital gain is not chargeable to tax. Also, if you have, say, 30,000 pounds in that ISA and it has earned overall, say, 500 pounds of interest income, that interest income is also exempt. So ISA is a route of doing what? It is a route of converting your incomes into exempt incomes, or converting different sources into sources that will give you exempt income. Now, every individual has an annual limit of 20,000. You can keep on contributing 20,000 pounds to an ISA. Now, on death, ISA allowance equal to the deceased individual's ISA savings can be claimed by the surviving spouse. So, the ISA of the deceased spouse gets transferred to the surviving spouse, and the same benefits are extended. The deceased individual's ISA savings will retain their beneficial tax treatment. So, if the husband had shares of Reliance in his ISA account and on his death they get transferred to his wife, then even for the wife, although she had not made that investment, the transferred shares in that ISA account will be carrying the same tax treatment, that is, they will be exempt from capital gains. So this transfer of the ISA from the husband to the wife also brings in a lot of tax exemptions or beneficial tax treatments that the deceased spouse used to enjoy. On death, ISA savings left to the spouse is an exempt legacy and not taxable. The entire amount that gets transferred from the husband to the wife, naturally, any transfer from the husband to the wife under inheritance tax purposes is an exempt transfer. The surviving spouse or civil partner is entitled to the allowance even if ISA assets are left to someone else. So, a person could leave his entire ISA assets to his son, but the 20,000 benefit, the 20,000 annual allowance of investing in ISA, the wife will have her own. The husband's 20,000 will also come to her, although assets are transferred to someone else. When the assets are transferred to someone else, there will be inheritance tax implications. Had it been transferred to the wife, it would have been an exempt legacy. So, to be a little dramatic about it, in sickness and in health, till death do us part. Even after death parting you, for a married couple, the tax benefits, come and get transferred from the deceased spouse to the surviving spouse. Now, in inheritance tax, there is again one very specific provision which connects the spouses or married couples. That is related property. This is a concept exclusive to inheritance tax. What is related property? Property is related to the donor's property if it is a property of a similar kind owned by the donor's spouse. For example, the donor has 6 antique chairs. The husband, who's the donor, has 6 antique chairs. The wife has 8 antique chairs. It will be considered together. So they are the antique chairs that the wife has is considered related property of the property owned by husband or the donor. Now, in case of related property, there is a reason why it is treated as related property. What happens is, think about a situation where you own only 2 antique chairs. The value could be 2,000 pounds. But when you own the entire antique chairs ka set, okay, when you own the entire antique chairs ka set, is 1 second, there's some network challenge. Okay. Now, so understand the situation that 2 chairs would have a lower market value as compared to 6 chairs, a set of chairs, set of 6 antique chairs, which is like a full set, will have more market value. Now, what people do is they very smartly, they split this related property between the husband and the wife. So the value with each spouse is lower. To counter this crafty tax planning, the concept of related property has come into existence. So if related property is unquoted shares, the valuation rule is very clearly given. So if the donor, that is me, if I am transferring the 2 antique chairs to someone for the purpose of valuation, you will not take the 2,000 ka value for the 2 chairs. You will take combined value of 6, which could be say 10,000, and then do 10,000 into proportionate amount to calculate the transfer of value for me. And it helps to counter this splitting that is done to reduce the tax. So if the related property is unquoted shares, how do you calculate the value? It is A upon A plus B into value of total combined assets of a similar kind. Okay, total combined assets of a similar kind is the total value of that 80% shareholding that you might have together. A is number of shares held by the donor and B is number of shares held by the related parties. When it comes to other assets, let's go back to the chair wala example. What is the transfer of value that you would calculate for me? You would do value of total combined assets of similar kind. 2 chairs ka value is 2,000, but 6 chairs ka value, set ka value is 10,000. So value of combined assets of a similar kind, 10,000 into A upon A plus B, where A is value of donor's assets, value of my assets, B is value of my wife's assets, and that way you can calculate the correct reduction of value for inheritance tax purposes. Related property also includes property of a similar kind owned by an exempt body as a result of a gift from that person or that person's spouse. Now, if you remember, at one point we did discuss the election to be treated as not UK dom. A spouse who is not UK domicile might make an election to be treated as UK domicile. Now let's understand how that election works. The election can be made anytime during the non-UK domiciled spouse's lifetime and can apply from any date within the 7 years prior to election. We have discussed why this election is beneficial. This is the administrative part, which basically tells you the timelines and provisions for making these elections. The election can be made within 2 years of the death of either the UK domiciled spouse, where the non-UK domiciled spouse is still alive, or the non-UK domiciled spouse, where the UK domiciled spouse has previously died. It can be made during any time when the non-UK domiciled spouse is alive. It can also be made within 2 years of the death of either UK domiciled spouse or non-UK domiciled spouse, subject to certain conditions. The election is irrevocable. What does that mean? The election once made cannot be reversed. The election is irrevocable while the electing spouse is UK resident, but lapses if that spouse becomes non-UK resident for full 4 consecutive years. The conditions for residential status are rather in-depth. You have to check the automatic non-residence test and automatic residence test, then sufficient ties test to determine whether a person is domiciled or not domiciled in the United Kingdom. The election only applies to inheritance tax, and the election may be beneficial where assets of more than 3,25,000 are transferred to a non-UK domiciled spouse. So if the election is made by a non-UK domiciled spouse to be treated as UK domicile, it is irrevocable as long as the spouse is UK resident. But the moment he becomes non-UK resident for 4 full consecutive tax years, the election is reversed. And one last part, that is business property relief. Now, business property relief is a relief that significantly reduces the value of lifetime gifts and the value of an individual's death estate. There are 4 types of assets which, when transferred, qualify for business property relief. One is the disposal of an entire business. The second one is unquoted shares. Then we also talk about quoted shares. And the entire concept of business property relief is applicable when one of the 4 assets that we have discussed, when that gets transferred. Now, one of the conditions to be satisfied to qualify for business property relief is that it must have been held for a minimum period of ownership, and that minimum period is 2 years. But if the asset that you are talking about was acquired or was inherited on the death of the spouse, the period of holding for the deceased spouse is also added while determining your overall period of holding. So when we are talking about business property relief, we have to be very careful that when you are determining, there is one condition which says that the minimum period of ownership has to be 2 years. When you are calculating the period of ownership, if the asset was inherited from a deceased spouse, then the period of ownership for the deceased spouse is also considered. Now that, in short, was, specific cases in income tax, capital gains tax, and inheritance tax, where the presence of a married couple or a civil partnership gives you certain tax-related benefits. There is one more provision called family companies, but that is a separate discussion altogether. So we are not going to mix that with this. So for the next 4 weekends, every Saturday, we'll be conducting one such basically webinar or boot camp of sorts, wherein we'll be revising one concept. Today, we discussed the reliefs in case of individuals when they are married couples. Naturally, in the next session, we'll be looking at capital gains reliefs that are available to individuals. So that will be a slightly longer session. For those of you who are already a part of the class, I will of course see you in the next session. The others, you can get in touch with our experts who can guide you more, who can guide you in detail for ACCA. Thank you so much for your time. These notes will be shared with the participants on as a part of the description on YouTube. Okay. Thank you so much, guys. Have a good day. I'll see you soon for one more of a similar session. Thank you.
Thank you, sir.
Thank you.
Thank you.